let's welcome on board the next management on the show. We have with us Mr. Anurag Mantri joining in. He's, of course, from Jindal Stainless Limited, joining us to talk to us about how the company is doing and what's the latest. He's the Executive Director and Group CFO at Jindal Stainless Limited. Hi, Mr. Mantri. Good to have you on the show. I just wanted to begin by discussing the latest development, which is the release of the pledge. What led to that, and overall, this overhang going away from the company, what does it really mean?
Yeah, sure. So I know, thank you so much. If you recall that the share pledge have been going on since almost 2010, and this was a big overhang on both of the investors as well as all our lenders. And I'm happy that, in fact, lenders have agreed to release entire shares, which is almost 78% of the promoters' shares were pledged. And with our continuous performance and the kind of business model and operational performance we have delivered over past 3 years, and which has also seen in our rating, which has been now double A, which we can clearly see that lenders have got a good confidence and they have released the entire shares of promoters. And this will obviously sure give us a good fillip in the both in for the equity investor as well as on the lenders side for the future capital. So this is a good development, and this was a big overhang for most of the equity investor as well as for raising new debt capital for us.
Point taken, but going forward, given your rating has improved as you talked about, what will it do to your cost of borrowing? And secondly, I think the net debt has been coming down. It's close to around that 2100 rupee mark, 2100 crore rupees mark. What's the roadmap for the leverage going forward?
So, if you see leverage wise, we are one of the best in the metal industry despite being in the Capex cycle. So, if you recall, we have just doubled our capacity in 3 months back from in a Risa plant from one to almost reach to 2.2 million ton. So, with the total capacity of 3 million ton now. Despite all these capexes, and we also acquired few of the assets in Indonesia in terms of the nickel backward integration of nickel, as well as on the JUSL, which was the hottest strip mill. We acquired the Rati, and despite all these organic and inorganic capex, our debt equity is just zero point 0.2. And going forward, what we are expecting to maintain around these ratios, which are very healthy, and we don't see so this year we still have a capex of close to 3,300 crore between JSL and JUSL, which is our another major subsidiary, and still we don't see a debt increasing by more than 200 crore. So largely these capex will be funded from internal accrual, and there would be only 200 crore increase from the March 23 level of debt. So overall, largely these capex will be funded through internal accrual. So we see a good, healthy, well, continue to maintain a very healthy ratios, both in terms of debt equity and debt EBITDA side, and don't see any of the pressure on raising a large quantity of debt.
Okay, right, Mr. Mantri, thank you so much for that. But, let's talk about the industry level, right? Higher in Chinese imports into India at subsidized rates continue to be a very big problem for the industry as well. Now, one, how is the company maintaining its volume growth despite this increasing imports into India? And are you hopeful that the countervailing duty being imposed on stainless steel imports soon, that is something that we could watch out for as well?
So, if I say about the imports, I think if you see the import pattern, last quarter, if you see on a year-on-year basis, imports have increased by 26%, and out of which 55% were hijacked by Chinese import. So we see a big gap, big kind of unabated imports coming from China market, which are also not giving a level playing field. The other problem with these imports are these are generally the Chinese productions are from the blast furnace based, which are bringing high carbon emissions into the country. So it's increasing the carbon emission load for the country, these imports. So one is that these imports are actually more creating pressure on MSME manufacturer, because for us still being a high-end market, we still have some of the export avenues as well as on the high-end avenue, but it continue to put pressure on our margin. But for the smaller player, it becomes they are almost cannot survive. So if you see, most of the MSME manufacturer are right now in fact operating just less than 50% capacity right now, which is actually a major deterrent for the entire Make in India effort. So we hope that these CVD measures and these should be taken quickly, because this will give us two advantages to the country. One is that it will help to develop the MSME manufacturing ecosystem in line with Make in India. Second, it will also reduce the carbon emission load from these lower end Chinese imports which are coming into the country. So I think hopefully the government should take cognizance of these, and overall it will be good for the overall Indian manufacturing ecosystem as well as the carbon emission ecosystem.
Also, I just want to know in terms of more about the volume guidance for FY24 as well as FY25, and what is it that we can expect in terms of revenue as well as EBITDA also for both these years as well?
So for FY24, our guidance is around 20% over FY23 number. And then now we are targeting another 20% growth in FY25 over 24. So if I see this year, put together 2 years in FY24 and FY25 as compared to FY23 number, we expect our volume to grow almost by 44%. So which is a good volume growth which we are targeting. Obviously, external factor will always be keep playing, especially the two part. One is that our export market, which are largely the US and European market, and secondly also the how the Chinese imports continue to play into the India and the government measures to protect those things. But we are hopeful to deliver at least 20% growth in another FY25 also. So in FY25, so this year we are targeting close to reaching 2.15 million ton, and the next year around 2.5 million ton. So overall, 44% growth in 2 years over FY23 numbers.
Okay, that's a very solid growth assumption that you're putting on board. But Mr. Mantri, if I can get more details from you, when you say that domestic demand is holding up, talk to me which segments are driving this demand. And secondly, with respect to pricing, what's your expectation? Is there a northward bias?
See, on the domestic side, I think what we have done in our business model, we have made our business model as segment independent, because there are multiple earlier our dependency on a strategically, if you see the larger steel sector dependency is high on the infra segment. But especially for stainless steel, we have now made ourselves as a segment independent, and we have developed our product mix. So now no segment is actually contributing more than 15 to 20%. So it de-risks our business model from if the particular segment is not doing. So for us now, auto, railway, infra, consumer durable, all put together are actually contributing this, driving this growth. So even if sometime one segment, say like auto is struggling with, if in between was struggling with further chip shortages, but we still continue to grow our volume, because that is the testimony of our business model. We can actually switch to the other segments which are actually doing well at that point of time. Government's program of Gati Shakti program has given a new good flip to the railway volumes, so which continue to drive our volume. So we will see a demand pull coming from across the segment, because stainless steel people are now realizing as a life cycle cost basis, and stainless steel uses are increasing across the segment. And so we continue to see across the segment growth. I would not put that only one segment will be driving, but I would say like over and top of it, the newer end segment, like which is the primarily we call it a green and blue economy. Green is largely for the related to green energy, and blue is related to the water related economy, where the stainless steel uses are actually increasing considerably. And say, so like whether it's in on energy side, whether it's the biofuel, it's a CNG, LNG, CNG, all these actually have a large stainless steel uses. Similarly, on a water treatment side, the stainless steel is the key material which to be used. So we see both the newer areas as well as the existing area continue to drive the solid growth to the overall thing. And we being operating on the upper end of the product mix, so which is good for the country, because our largest market is, if you see, was actually the European Union, which are very high on the automation and process industry. And we want to replicate the similar sort of product deliveries to our Indian economies. And therefore, it's also, again, I'm coming back to that critical to register for the Chinese lower end Chinese imports
No,
in the
I
country.
understand. No, I understand the importance of that. But just Anurag, in the interest of time, quickly wanted two things from you. You gave us the volume guidance for the next couple of years, but talk to me about the EBITDA spreads as well. And my question on the pricing as well. How do you see that moving forward?
See, EBITDA guidance for us this year was 19 to 21,000, which is there by, I think, what we are seeing is that I think last in H1 we delivered close to 20,000. And since they right now we see a pressure on both US and European market, but still we are seeing that we should be able to deliver almost close to 20,000 of EBITDA guidance. But we are maintaining our guidance. Let's see how the market unfolds. But I see moving toward 21,000 at this stage looks challenging, but 19 to 20 will still be within our range of 19 to 21 for this year. Next year, it's a bit early. Overall pricing side, in stainless steel, it's a pass-through model, what we say. And right now, since the raw material prices are also lower, so we are actually passing on that benefit to the consumer, and we reduces our prices immediately to give benefit to the domestic consumer. So the prices overall realization remains down, but that's also a pass-through model, but we'll be able to maintain our EBITDA numbers.
Right, Mr. Mantri, thank you so much for joining in with us this afternoon on ET Now, talking to us about in terms of what we should be expecting in terms from the company, in terms of volumes going forward as well. Thank you so much, Mr. Mantri. So yes.